Get started with our masterclass on MACD, Moving Average Convergence and Divergence. Now, MACD was developed by Gerald Arpel in the late 70s. And to be honest with you, most of the main indicators or the most respected indicators in the market were developed about the same time. And they've been around for 30, 40, 50 years. Why? Because they work. Now, as all of us of you were around the late 70s, I was already out of high school then. I was actually out of university then. But if you remember, then we didn't have any online trading. We didn't have Forex trading. We didn't have CFDs, and we sure didn't have cryptocurrencies. But over the time, Gerald Arpel has adjusted his indicator to work well in all financial markets. And is used to spot changes in strength, direction, momentum, and duration of a trend. That's a lot of information you get from one indicator. Now, the letters MACD stand for Moving Average Convergence Divergence. And it's an indicator that falls into the group of what we call lagging indicators. The basic function of MACD Forex indicator is to discover new trends and to help identify the end of the current trend. There are various ways to gauge these signals generated by MACD, and many traders also use their own unique settings within this indicator and set up their own strategies. Now, MACD gives us three vital pieces of information. It will give us overbought and oversold indicators. It will give us transaction signals like buy and sell or entry signals. And it will also give us divergence. So this is a lot of information that you can get from one indicator. Now, the MACD indicator is typically placed at the bottom of the trading chart in a separate window, just like you do with most indicators. There's only very few indicators that are actually done over top of price action. Now, the moving average convergence divergence is a relatively easy tool. However, it is crucial to understand it fully before attempting to use its signals. Now, the mathematical calculations to calculate MACD are not complicated. And once you understand where each line and each calculation comes from, you'll be able to spot false signals and good signals. You'll be able to see when the signals are a little bit out of whack because you'll understand where they're coming from. Or when you see price doing something different, you can say, I understand why this is happening. Because it's very important to understand why a signal is happening or why you're getting a reading, as opposed to just following somebody's set of rules. Now, there's all kind of gurus out there in the marketplace that are pushing their interpretations. And they tell you, when this happens, this happens, this happens, you do that. Well, that's not the really way you should trade. You should see when this is happening, I'll analyze that. And when that happens, I'll analyze that. And when that happens, I'll analyze that. And then I'll draw my own conclusion. And you're only going to be able to draw your own conclusion if you know why those things are happening. Now, the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 12-period and 26-period exponential moving average. Okay. Now, the math behind an EMA isn't all that important for us to get involved in. But an EMA, as opposed to a simple moving average, gives a little bit more weight to the most current prices and a little bit less weight to the older prices in that price realm that you're using for your averages. And we're going to use two moving averages to start out with, because MACD is a derivative of a derivative of a derivative of a derivative. So that means we use four different pieces of information moving away from price to get the final MACD. So we start out with a 12-period and a 26-period moving average. Now, you could start out with a 20 and a 19 if you wanted, but Gerald Arpel developed this and tested it, back tested, and the markets have been using it this way forever. Now, you can change it to a 23-period and an 8-period, But then it's no longer MACD, it's Barry's indicator, or Bill's indicator, or Bobby's indicator, Tony's indicator. And then you have to go back and test your own adjustments to make sure that they work and they're not just happen to work good today only. So let's go over to a live chart and let's start seeing where we actually start with this indicator. So here we have a current chart for gold. Okay, I'm just waiting for it to pop up on the screen. Okay, and on this chart, we're going to start out with putting our 2 moving averages on this chart. So we simply go up to the indicator line and locate moving average exponential. Okay, so we come down here and we just locate, but this is only for how we're going to learn this, because MACD, when you click on MACD, when you go to, it does it all, the calculation just drops it on the chart. But we're going step by step. So we're going to come down here to moving average, and we're going to look for exponential moving average, and we're going to click on it and put it on the charts. Now I've got it set up ahead of time because we've got to have class ready. So we have two moving averages. See the red line and the blue line on the chart. Okay. The blue line is the 12-period moving average. What that means is we're looking at a 1-hour chart of gold. It goes back the last 12 1 hours, adds them together, and again puts a little bit more weight to the most current hour, and divides it by 12, and that gives us the current moving average on a 12-period for gold. Plain and simple. We also take a 26-period moving average. So that would take the last 26 bars of the close, divide that by, add them together, divide it by 26, and plot that on this chart. Now, excuse me. The blue line, or the 12-period moving average, is referred to as the faster moving average. Why? Because it is the shorter number or shorter period. The shorter the period, the faster it reacts to the most current movement. The longer period, because you're using 26 periods, reacts slower. So in other words, if gold was trading at hypothetically $1,200 9 hours ago, $1,200 8 hours ago, $1,200 all the way down to right now, and then it jumped up to $1,300, we'd have 9 $1,200s and a 1,300. Add them together and divide it by 12. Well, that 1,300 would have a bigger impact than if we went back 26 periods. We added 25 periods of 1,200 and 26. So that's why one is called a slower and the other is called a faster. Okay. And it doesn't matter what moving average system you're using, it's always true. The shorter the period, the faster it reacts. So it's always referred to as the faster, and the longer period is always referred to as the shorter. So if you're trading with a simple moving average crossover using a 10 and a 30 period moving average, or a 50 and 100 period, the smaller numbers always the faster to respond. So it'll be referred to as a 50. So in this case, we're using a 12 period and a 26 period as determined and practiced and back tested by Gerald Rappel, who developed this indicator. Now, the fact is MACD is not put on your charts. You don't ever see the moving averages on the chart. It's the first part of the calculation. So the first step in MACD is to determine the two moving averages, the 12 and the 26. Then we go and we find what's called the MACD line. The MACD line is placed below your chart and is placed on a scale with a 0 in the center. And it is simply the difference between the 12 period and a 26 period moving average. The reason we start out with a 0 in the center is, guess what? Every time we have a crossover of those two moving averages, what do you think the price would, the value would be? The value would always be 0, because when the two lines are crossing, they're the exact same number. So when you subtract the 12 period from the 26 period, you get 0. So anytime the MACD line we put below reaches 0, you know that the lines, the moving averages are crossing over. But again, if that's all that we were doing, we're simply trading a moving average crossover strategy. But this is just the start of MACD. So the first line on the MACD indicator is called the MACD line, and it's just the difference of these two numbers above. So once we have these, we no longer need to see these numbers on the chart. They're gone. Now we're dealing below. Now, every time we see the line move above the 100, what does that tell us? That the moving average, the shorter moving average, is growing much faster and larger than the slower moving average. Every time it drops down below 0 into a negative number, it tells us the shorter moving average is smaller than the longer moving average or the slower moving average, because when you're subtracting the 12 period from the 26 period, and 26 period is larger, it's a negative number. So we can then see, by looking at this line above and below the 0 line, which direction the asset is moving. So actually we can see here, look at this. It pumped all the way up because what happened? Prices moved up. Again, it fell down as prices moved down because the slower moving average was getting larger than the faster moving average. And if you actually put these back on the chart, you would see that. See here, the red moving average line, which are slower, is larger than the blue moving average. So this is why it's moved under the 100 into the negative territory. Here we see the blue line over the red line, or the slower, larger than the faster, and this is why it's above. So all of that information on those two moving averages is contained down below in this MACD line. Now, like I said, if we were to use just this, we're just trading a simple moving average crossover strategy. It doesn't tell us much information. So MACD goes on a couple steps farther, but the next step that MACD does, it comes up with what's called a signal or a trigger line. This trigger line or signal line is a 9-period moving average of the MACD line. So whatever the MACD line was above, it was 0, 0, 0, 0, 0. It would take a moving average of all those zeros and it would give you a 0 again. But it's simply a moving average of the line above, the MACD line, the blue line we have here, and the red line is a moving average of that line. Now, I have set these colors and these numbers. Okay, the standards are for the MACD are the MACD line is in blue and the signal line is in red. You can make them any color you feel like using. Okay, it's completely up to you as long as you know which one represents what. That's all that matters. So now what we have is this signal line, or referred to as a trigger line. When the signal line crosses the MACD line, that gives us transaction signals, buy and sell signals. And this is the first bit of information we start getting from this indicator. But we're still not finished. We're going to go some few steps farther. But let's go talk about what these two lines do now that we have them on a chart. So let's go back to my PowerPoint. Okay. So on the MACD chart, a 9-day EMA of the MACD itself is plotted as well. And it acts as a trigger for buy and sell decisions. The MACD generates a bullish signal when it crosses above its own 9-day EMA. And it sends a sell signal when it moves below its 9-day EMA. Now, we're going to go the next step farther, which is called the MACD histogram, but we're going to get back to the histogram in a minute. So the moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies that we have. While it is slower than momentum indicators such as stochastics or the relative strength index or commodity CCI, if you are willing to sacrifice a little of speed in exchange for safety, it's good at keeping you on the right side of the market, because we can see all the information about price and also where the trend is moving in the movement of these lines below the chart. And you always want to be trading on the side of the trend as well as the side of the momentum. Now, MACD is perhaps the best all-around study available. Indeed, I consider the MACD the best single oscillator available, and it's valuable to learn its nuances inside and out. Other than the price trend itself, MACD is the most accurate probability signal. The new trader would be wise to concentrate on really learning the MACD and its histogram before moving on to other oscillators. So, as we can see in this chart, whenever the MACD line crosses its signal line, it gives us a buy or a sell signal. When it crosses down and below, it's giving us a sell signal. When it crosses down and below again, it gives us a sell signal. When it crosses down and over, it gives us a buy signal. And it generates these early enough that we can actually see what's happening with the trend. Now, the thing is, because MACD does not take into its consideration at any time the volatility or the swing of the market, and it generates a lot of signals, it generates what we're going to call a lot of false signals. A false signal is not a bad signal. It can generate lots of signals so you can get whipsawed in and out, because the MACD line doesn't tell you how far it's going to move in that direction. So it tells you to buy and the asset will jump up, but it may not cover your spread, or it may only jump up for 2 bars and come right back down and you may get across. So you get whipsawed in and out of a lot of trades. So you need to use other determination factors as to whether you're going to trade that signal or not. Because the signals are reliable, it's using risk-reward management and other signals to confirm that you actually want to make the trade. So in downtrending markets, the fast-moving average will move down faster than the slow-moving average. As the fast-moving average diverges from the slow-moving average, MACD will illustrate that relationship. And in uptrending markets, the shorter moving average should move up faster than the slower. As such, MACD will move higher to express this growing difference. Now, notice in this chart that the MACD helped traders notice the trend change from a very early stage, as the blue boxes above to the left, okay, began before the downtrend was completely finished. It is a key part of the indicator and something we will delve into much deeper when we look at histograms. But using MACD as a trigger into trades. But before we get into that, you'll also notice the zero line drawn on the MACD indicator. This is a key part to the indicator as it shows us when there is no difference between the EMAs. MACD will cross the zero line as the fast and the slow moving averages intersect. And it is very important because we don't care about the moving averages above on the chart. We're only now interpreting the relationship between the MACD line and the signal line or the trigger line. Okay. And the relationship in the formations they're making and the height and where they're crossing over and in which direction they are crossing. So MACD may be helpful for noticing potential trend changes at the very early stage. However, if we wait for the zero line crossover, we are essentially trading a moving average crossover, which is inherently lagging. So this is where the signal line comes into play. The signal line is simply the moving average of the MACD line. Building on that relation to the MACD line itself, traders will often look for entry opportunities when MACD crosses the signal line. When the MACD line crosses above and over the signal line, it is looked at as a buy signal. So basically, when we see this happening, it's a buy signal. When we see this happening, it's a crossover, would be a sell happening. Now, we're going to go over and take it one step farther. And this is called the MACD histogram. I'm sorry, I just want to get my markings off this chart here. Okay, and the MACD histogram helps us see all of this in one little chart. So let's go over to our gold chart. And okay, I just turned all this off as we go through. So now when you actually drop MACD on, when you go up to an indicator, no matter what chart it is and just come down to MACD, it's going to drop it on with all of these lines that you see down below. No moving averages on the chart, just the lines that you see down below. And so you don't have to do any calculation. You don't have to put the lines in, you don't have to do anything. It's going to give you the signal line, it's going to give you the MACD line, and it's going to give you the histogram. Now, if you look at the histogram is simply the difference between the MACD line and the signal line. Okay. And when you subtract one from the other, again, we're back on the zero line. And when the MACD line crosses the signal line, where is it? It's always at zero. When the MACD line crosses above and over the signal line, it's above zero. So you can see that in these mountains or peaks. And when it's below in these troughs or valleys, that means it's the MACD line has fallen below the signal line. And if you look, when it's below, it's usually in a downtrend. When it's above or moving above, it's moving an uptrend. But it doesn't. It's dealing with the moving averages as opposed to price, because price can have a very steep uptrend and you'll get a very small move in the MACD line or the MACD histogram. So what we have now, and now a lot of people, myself included, don't need to look at the MACD or the signal line. You can see everything that you need to see in this histogram. Because in the histogram, your crossover is there, the width of the separation of the lines, and how wide or how. So when we see these large peaks or valleys, not just a peak or valley, but we see a large move, okay, it's telling us that asset is overbought or oversold. Too much buying or too much selling. When it crosses at the zero line, it's generating buy and sell signals. And if it crosses the zero line and goes downward, it's generating a sell signal. Crosses the zero line and goes upward, it's generating a buy signal. And we can almost see the momentum in these lines. So in an effort to more closely follow the relationship between the MACD and the signal line, traders follow the histogram, which is simply a bar chart plotted around the zero to indicate the relationship between the MACD and the signal line. Now, we have three different stories when we're looking at these lines on the bottom of our chart, the MACD indicator down below. The MACD proves most effective in wide swinging trading markets. There are three popular ways to use the moving average convergence divergence. One is crossovers. Crossovers generate transaction signals, buy and sell signals. Then we have overbought and oversold conditions. And then we also get divergence. So there's a lot of information on this chart that and many different ways that we can use the MACD indicator. So the first basic rule, or the first basic part of MACD that we use, is the crossover. The crossover generates buy and sell signals. So the basic MACD trading rule is to sell when the MACD line falls below its signal line. Similarly, a buy signal occurs when the MACD rises above its signal line. So when MACD rises above its signal line, what happens? It rises above zero. When MACD falls below its signal line, it hits zero and then falls below. So as we can see here, MACD crossed over, or we can see it right here, and it crossed over downward. So it gave us a sell signal at that point. Here it crossed over upward, and we can see it in the histogram, or we can see it with the two lines, and it generated a buy signal. Here, the opposite. Here the opposite. Here a sell signal. Here another buy signal. Here another sell signal. And you can either see it on the two lines, or you can simply look at the histogram. Again, you can see it here on this chart. Now, MACD also tells us overbought and oversold conditions. And that's very important to know. Now, an overbought market doesn't necessarily fall at that moment. It means that there's too many buyers and the price has been driven up too high. And if you think of an overbought market like a rocket shooting up into the sky, at some point, gravity is going to take over and the momentum is going to lose and that rocket's going to fall back down. But yes, if you're a scientist with all the computers, you can calculate exactly when, if you had the exact weight of the rocket, the exact wind speed, at what point it's going to lose its momentum and flip over. We don't have that in trading. But at some point, when we get way into the overbought zone, we're waiting for that rocket to tip over. But it can keep going before it tips over. So oversold is the exact same thing. And then we have divergence. Divergence is when the indicator itself is making opposite moves than the price chart. So in other words, when we look on this chart here, we can see that the price is in a downward movement and is making lower lows. When we see our indicator at the same period, now this is just our MACD line, is making higher lows. So what's got is we have bullish divergence because it is pulling away. The indicator isn't doing the same thing as price. That gives us a very strong look at that trend is about to end. When we get the crossover, that reinforces that and tells us a very positive view of what's happening in the market. So an indication that the end to the current trend may be near occurs when the MACD diverges from its symbol. A bullish divergence occurs when the MACD indicator is making new highs while price fails to reach those new highs. A bearish indicator occurs when the MACD line is making new lows while price fails to reach new lows. And bearish divergence is exactly the opposite. Here we have a rally in prices and prices moving up, while our MACD line is making lower highs while the price is making higher highs. We get the breakout at this point when we get the crossover, and we also see a broken support and resistance line, and it's telling us that that trend is at its end. So remember, the MACD indicator is a four-step derivative. The first derivative is the 12-day EMA minus, or the 12-day and the 26-day EMA. Then once we have those, we do the second derivative, which is the 12-period EMA less the 26-period EMA. The third derivative is the MACD signal line, which is a 9-day EMA of the MACD. And the fourth divergence is the MACD histogram, which is the MACD less the MACD signal line. But now you know what all of these lines tell you. Now, it's very important that once you have all these lines on the chart, you start looking at them closely and be aware of what they're trying to read, or start seeing what they're trying to tell you. It's become standard to plot the separate moving average alongside the moving average, which is a signal line or trigger line. And this will generate the crossovers, will generate transaction signals, buy and sell signals. And this is what traders are always looking for, buy and sell signals. The basic bullish signal occurs when the MACD line crosses above the signal line. And the basic bearish signal line generated when the MACD crosses below. Now, as mentioned earlier, we want to watch that zero line. That zero line is critically important. Okay. And given the construction, the value of the MACD indicator must be equal to zero each time the two moving averages cross each other. And as you can see in this figure 3, the cross to the zero line is a very simple method that can be used to identify the direction of the trend at key points when momentum is building. Now, the biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of several times before being able to capture a strong change in momentum. So traders should be aware of the whipsaw effect can be severe in both trending and range-bound markets. Okay, and when commissions are factored in the equation, the strategy can become expensive. So we want to use other indicators or other factors to make a determination. Once we get, if we think of this as a buy alert or sell alert, we still have to then make a determination as whether we're going to buy it or sell it. So the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. Clear transaction signals help minimize the subjectivity involved in trading, and the crossovers, the signal line, make it easy for traders to ensure that they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this simple indicator can quickly be incorporated into any strategy. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and start using MACD, watching it, and you would learn it, and you'll be able to master it in no time. Once you can see that histogram and see what it's trying to tell you, you find out that it's very reliable and that you can easily do this. It's not a very time-consuming effort, and it's not going to take you months to master. So put it into your trading strategy, start watching it, and start seeing how it works right for you. And on that note, have a good night now. Thank you for supporting Trade Fred and investing.com.